results. Revenue at 3.17 billion euros, up 4.2% year over year.
Reporting third quarter sales up 4.8%. Franklin Golf Romeo.
The Fed policy will be driven by the pace of the data. Same policy will remain accommodative.
Futures off sessions low, still down about 1% on the day for a little more than 4 pennies.
This study. Obviously, in the days before the earnings release, front month options see an increase in implied volatility due to the uncertainty because although there may be whispers about the number and very few people know exactly what they are, there's that uncertainty built up in the market. So because of that, front month options have a higher implied volatility against the back month options. So there's a positive horizontal skew that's present in the market. So I wanted to see how to take advantage of this volatility crush. Basically, after the earnings are released, that front month options premium really crashes, and I wanted to see what the effect would be over a certain period of time. And as the last bullet says there, the volatility crush usually is more pronounced in the front month options. You'll get it in the back month more or less, but it will be more pronounced in the front month. So,
right. Just as an aside, as you're flipping your slides, Chris, who's one of our other mentoring students, mentioned that Augen book that you just mentioned, the UPS guy literally delivered that to Chris 3 minutes ago.
Yeah.
I don't know if you guys are coordinating this act or not, but that's a pretty funny coincidence.
Yeah, it's a good book. It's very valuable.
Yeah.
He does a lot of good work.
Augen wrote the book that Craig Wassenberg based his expiration week plays strategy on, by the way.
Oh, okay.
Yeah.
All right.
All right. So, go ahead.
So going forward, some of the assumptions that I had even before I started this study was that it was my perception that stocks that move more than the market have a higher implied volatility. And also, stocks that have higher prices will have higher implied volatility because they will generally move more than the market. So I had those two assumptions in my head, and I said, how do I isolate those stocks? Because that's where I want to concentrate the study. So I used the MS Money Screener, and I put two different screens in. The first was for I wanted a stock price above $75, and the second was I wanted a beta of greater than 1.15. Now, the beta, just let me talk about that for a little bit. It's the number describing the relation of the price movement with that of the benchmark index. So, for example, if you're using the SPX as your benchmark, which usually in most studies that'll be used, if the SPX moves up 1% today, and let's just say Google moved up 1.15%, that is a stock with a beta higher than 1. Okay, so I was looking for these stocks that when the market moved up 1%, I wanted them to move up greater than 1%. If the market moved down 1%, I wanted them to move further down than 1%. So I really wanted those stocks to have exaggerated movement. Because, again, my assumption was that there's going to be higher implied volatility levels in those stocks. Okay. Now, one of the things, I'll just mention it here quickly because I know it'll come up. One of the, I'll call it a vulnerability, but I actually did something I did something later in the brief by a recommendation of the options training group. I did an intellectual check, but basically.
Thank you for watching this clip of our Options Tribe webinar. The rest of the recording is available on OptionsTribe.com. I'm Seth Freudberg, and I've been hosting the Options Tribe since May of 2011. We've brought in options experts from all over the world to make excellent presentations to our members. So go right now to OptionsTribe.com to learn more about options education, or you can send me an email at sfreudberg@smbcap.com.